Ever feel like the stock market is speaking a language you just haven't quite mastered? You're not alone. Millions of people want their money to grow, to work for them, but the sheer complexity of investing can feel overwhelming. Where do you even begin? What stocks? What bonds? How much risk is too much? That's where the idea of managed portfolios comes in. Think of it like having a seasoned navigator charting the course for your financial journey. Instead of you constantly poring over maps and making every single turn, experienced professionals take the wheel, making investment decisions on your behalf based on your specific goals and risk tolerance. Now, there are a lot of different firms offering these managed portfolio services. So, the question isn't just what is a managed portfolio, but which one might be right for you. And that brings us to today's focus, Ally Bank Managed Portfolios. What exactly is it about them that might make them a compelling option in a crowded field? To really understand Ally's offering, we need to zoom out for a moment and consider the landscape of automated investing, often referred to as robo-advisors. These platforms leverage technology to provide investment management at a lower cost than traditional human financial advisors. They typically use algorithms to build and manage diversified portfolios based on your individual circumstances. Ally Bank, a well-established name in the online banking world, has extended its services into this realm. Their managed portfolios aim to offer a blend of sophisticated investment strategies with the user-friendly experience you might already associate with their banking platform. So, what are some of the key aspects that set Ally Bank managed portfolios apart? Let's dive into some of the core features and potential benefits. One of the first things that often draws people to robo-advisors, including Ally's, is the accessibility. Traditionally, getting personalized investment advice often required significant account minimums and ongoing fees that could eat into your returns. Ally managed portfolios generally boast low or no minimum investment requirements to get started. This democratizes investing, making it accessible to individuals at various stages of their financial journey, whether you're just starting out with a few dollars or have a more substantial amount to invest. Furthermore, the fee structure is a crucial consideration. Many traditional financial advisors charge a percentage of the assets they manage, which can become quite significant as your portfolio grows. Robo-advisors, including Ally, typically offer more competitive fee structures, often a relatively low annual advisory fee. This can translate to more of your return staying in your pocket over the long term. It's always essential to understand the specific fee structure of any managed portfolio service, but generally, this cost-effectiveness is a significant advantage. Now, let's talk about how these portfolios are actually constructed. When you sign up for Ally Managed Portfolios, you'll typically go through a questionnaire designed to understand your financial goals, your time horizon, how long you plan to invest, and your risk tolerance. Are you comfortable with the possibility of market fluctuations for the potential of higher returns, or do you prefer a more conservative approach focused on preserving capital? Based on your answers, Ally's algorithms will construct a diversified portfolio tailored to your specific profile. Diversification is a cornerstone of sound investing, meaning your money is spread across different asset classes, such as stocks and bonds, and within those asset classes, across various sectors and industries. This helps to mitigate risk, as a downturn in one area is less likely to significantly impact your entire portfolio. Ally typically utilizes low-cost exchange-traded funds, ETFs, to build these portfolios. ETFs are baskets of securities that track a specific index, like the S&P 500, or a particular market sector. They offer diversification and generally have lower expense ratios compared to actively managed mutual funds. This focus on low-cost ETFs further contributes to keeping your overall investment expenses down. Beyond the initial portfolio construction, the ongoing management is another key aspect. Ally's system continuously monitors your portfolio and automatically rebalances it as needed. Market fluctuations can cause your asset allocation to drift away from your target. For example, if stocks perform exceptionally well, they might become a larger percentage of your portfolio than initially intended, potentially increasing your overall risk. Rebalancing involves selling some of the overweight assets and buying more of the underweight ones to bring your portfolio back in line with your target allocation. This hands-off approach can save you time and effort, ensuring your portfolio stays aligned with your long-term strategy. Another feature that many users appreciate is the integration with Ally Bank's broader ecosystem. If you already have checking or savings accounts with Ally, managing your investments through their platform can offer a seamless and convenient experience. You can often view all your accounts in one place, making it easier to get a holistic view of your financial situation. Furthermore, Ally often provides tools and resources to help you understand your investment strategy and track your progress. This might include performance reports, educational materials, and access to customer support if you have questions or need assistance. While you're not getting personalized advice from a human advisor in the traditional sense, you still have access to support and information to help you feel informed and confident. Now, it's important to acknowledge that like any financial product, Ally Bank managed portfolios aren't a one-size-fits-all solution. While they offer numerous benefits, there are also factors to consider. For instance, if you prefer a highly personalized relationship with a dedicated human financial advisor who can provide tailored advice on a wide range of complex financial planning issues beyond just investment management, a robo-advisor like Ally might not fully meet your needs. While Ally offers customer support, it's not the same as having a dedicated advisor who knows your specific situation intimately. Additionally, while the investment strategies employed by Ally are generally sound and based on well-established principles, they might not be as actively managed or as tailored to very specific or niche investment goals as what a high-net-worth individual might seek from a private wealth management firm. The focus is typically on broad market exposure through ETFs, which is a sensible approach for most investors but might not satisfy those with highly specialized investment preferences. It's also crucial to remember that investing always involves risk. While diversification helps to mitigate risk, it doesn't eliminate it entirely. The value of your investments can go up as well as down, and there's no guarantee that you'll achieve your investment goals. The performance of Ally's managed portfolios will be subject to overall market conditions and the performance of the underlying ETFs they utilize. With that said, thanks for watching, and until next time.